Right. Good morning. Shall we start? Yes. Last week, the last discussion what we had. So it's just the introduction of taxation, right? So in the essence of the last discussion, which is I focus basically on the charging section, right? So charging section, which by under the 11 Act. Section 2, right? Basically, we plan for Sri Lanka. Okay. Who is liable for Sri Lanka income tax? That's the period. Year of assessment. Then person who is having simple income. The one who receives final story payment. So that is as per section 2. That is the scope of the 11 Act. So if somebody is coming within this scope, so then he is liable for Sri Lanka income tax, right? So for a year, any year of assessment, person who is having taxable income or receives final story payment, right? So then it says interpretation for the some important point. What is year of assessment? Right? As per the law, it says year of assessment is year of assessment is what is that is 12 month period. 12 month period commencing from first day of April of any year of assessment, any year, says any year. Ending with 31st March of succeeding year or the next year. Right? So that is 12 month period. So therefore, the income tax we need to work out for a year of assessment, right? Not any other period. Right. Then who is person? As per section 2, it says person is liable for Sri Lanka income. It says who is person? Interpretation for the person. What is the definition for the person? Understand? Individual, entity, individual entity, body corporate or unincorporated, body of person, corporate or unincorporated, etc. Then non-government organization, charitable institution. So it says if a person who has taxable income of final authority received, then he is subject to tax. Doesn't say that charity is liable for tax. No, not the case. The charity has taxable income or charity receives final authority payment, then they are liable for Sri Lanka tax. Right? Very simple. So under the entity, so it says again what is meant by entity. Entity says company, trust, partnership. Right? So this is the definition for person. Thereafter we learn we actually start the discussion on what is taxable income. Right? What is taxable income? It says taxable income means it says taxable income. So comprise with source of income. Right? Recognize sources. Also, that means the income which generated for a person. Right? That is taxable tax flow. What is that? The investment asset. Right? So it says in case of the taxable income, it says shall need to be worked out for each person separately. Each person separately. So that means person, a particular person may have to work out separately. So in the same thing, it says thereafter it shall constitute this assessable income. Assessable income. In the assessable income, that comes at section 4 says, in case of a resident person, wherever the source arises, that is for resident person, wherever the source arises. So we are not bothering about where that source is. Right? We know that one are source, these sources. In case of the resident person, wherever the source arises. So wherever that income generated, when we work out the assessable income, we have to consider. Right? In case of a resident person. So, and again it says, in case of a non-resident person, derived of derived from source in Sri Lanka. There should be a source in Sri Lanka. In case of a non-resident person, source shall be in Sri Lanka. So in case of the resident person, we are not bothering about where the source, wherever it is. In case of a non-resident person, if the source in Sri Lanka, then it will be part of that is accessible income. Right? So these are the very important points or the areas what we have discussed last class, the last lecture. Then we discuss resident concept, section 69. Right? Let's say residence here, individual. Company. Partnership. Trust. How to determine the residence? That is for tax residence. We call tax residence, but there is no concept for tax residence, but for the income tax purpose, Sri Lanka tax purpose, residency access how to determine the residence. So a particular person, whether he is a resident or not resident, based on these criteria, right? So in case of the individual, how to determine individual residency? Tell me. Residency of individual. So person who reside, individual who reside. That means Sri Lanka. So second thing is that so physical presence in Sri Lanka, right? That is actually applicable in person who arrive to Sri Lanka or depart from Sri Lanka, right? If they any 12-month period, within any 12-month period, commencing or ending in any year of birth, if some person individual physically present in Sri Lanka more than 183 days, important, more than 183 days, he shall be resident for the period so stay. So physically present in Sri Lanka. Right? Say, assuming that your investment is start from here. First April 2023. Right? So your investment ending with 31st March 2024. 12-month period. That is as per the definition. Right? So if any person who came to Sri Lanka, right? Came to Sri Lanka. We assume that particular individual came to Sri Lanka on 1st June 2023. So from that day of notice, we have to count 12-month period. Right? That particular 12-month period, if that person physically present in Sri Lanka more than 183 days, that particular period, right? Physically present in Sri Lanka more than 183 days, he shall be treated as a resident person for the period of stay. Right? For that particular period, for that year of person. That is said, start to end. Remember, this year is start, next year it is ending. 12 months period. Right? Goes to 31st May 2024. 12 months period. Right? For that particular period, he shall be treated as resident person for Sri Lanka. So then this period, for this period, this period, that period, for that period, he is still a non-resident. So says that 12 months period coming. It's coming from 1st June 2023. From that period onwards, we have to count for the 12-month period. That particular 12-month period, that person physically present in Sri Lanka more than 180 days. Then he become a resident person for Sri Lanka for that period. Right? So assume that he again went from Sri Lanka '24 up to that period, he is resident. That is holding on next year, right? Okay. So difference between the resident and non-resident. So why it is important? So how he should liable for what the composition of his assessable income? How we should work out his assessable income? So if we become a resident person individual for Sri Lanka tax, we are not bothering about where the source is. Where non-resident person to the extent that source in Sri Lanka. If there is a source in Sri Lanka, then he is liable for Sri Lanka tax. Right? So that is for individual. That's the two subsection what we discussed. If somebody resides in Sri Lanka, right, then he shall be treated as a resident person for Sri Lanka tax. So person, the second or the part B, that is physically present in Sri Lanka. Right? Then C applicable to government offshore employees who posted outside Sri Lanka on behalf of Sri Lanka government. For that, spouse and the particular individual shall be treated as resident person for Sri Lanka tax. Right? D. Employee works in Sri Lanka ship, which is registered under Merchant Shipping Act. So these things are specific things, right? Government employee and spouse. Other one is employee work in Sri Lanka ship. So working the employee who works in Sri Lanka ship, whether registered under the shipping Sri Lanka ship Merchant Shipping Act. So period he is in employment with that ship shall be treated as resident person for Sri Lanka. Right? Any person, any, right? So that is co-individual. Then import point is company. Company. In case of the company, say home or established incorporated in Sri Lanka in a law in Sri Lanka, as per the law in Sri Lanka. Right? Can be under Companies Act. Any other criminal law as per the law in Sri Lanka. Right? So incorporated of home as per the law in Sri Lanka, then it shall be treated as resident company for Sri Lanka tax. Right? That is say so is registered office or principal office in Sri Lanka or management is happened from Sri Lanka. Then that particular company shall be treated as resident company for Sri Lanka tax. Right? That is company. In case of the partnership, it says so if established or the home in Sri Lanka, then it shall be treated as resident partnership or tax worker. Or at any time, management or the control of the partnership is done by a person in Sri Lanka. That means partners are in Sri Lanka. Then it shall be treated as resident partnership. Right? So that means partnership may be incorporated anywhere. If the partnership management or the control of the managerial decision are taken by a person, a resident person in Sri Lanka, then that particular partnership shall be treated as resident partnership for tax purpose. Right? Right. That is partnership. So other one is trust. It says trust established in Sri Lanka, then it shall be treated as resident trust established. Second thing is says trustees are in Sri Lanka. Right? Trustees, they are in Sri Lanka. That one says senior manager decision or the strategic decision is taken by a resident person in Sri Lanka. Directly or indirectly through another interposed entity or person. If that manager decision, senior manager decision on behalf of the trust is taken by a resident person in Sri Lanka, that particular trust is treated as resident trust. Right? Yeah. That is resident. So now you know in case of the resident person and in case of the non-resident person, how we should work out the is tax liability based on taxable income or final installment received. So therefore, so tax liability of a person on taxable income final installment payment. Right? So when we work out the taxable income, we have to work out the taxable income. Difference between the assessable income. So assessable income would be from employment. Business. Investment. Other. Right? So then we have to work out separately for each sources need to be worked out separately. We have to work out separately. This could be total taxable income. Right? When we arrive at taxable income from assessable income, we can deduct two items. Qualified payment. Second thing is bill. These two things we can deduct. We have not yet studied this area. We'll discuss later. So then the answer we call taxable income. Right? So taxable income, on that we have to apply the particular tax rate and work out the tax liability. That's how tax liability is coming from this. The tax rate. That is as per the first schedule. That tax says what are the tax rate applicable to each person. Right? The final withholding payment also says they are telling what is final withholding and what the tax rate. Right? Here, remember, we work out the assessable income and thereafter we go to the taxable income. That's what first part. This part. Yeah, there. Right. How to work out taxable income? So before that thing, we have to work out the assessable income. Now we are in the discussion of assessable income. Assessable income can be coming from four sources. Employment, we are not discussing here employment. Business, yeah, we have start. Then investment and other sources. Right? This area we are discussing the classroom. So on that, the total assessable income, from that we can deduct two items that is as per section 52, qualified payment and relief. Once we done that thing, the answer is called taxable income. So taxable income we apply the tax rate and we work out the tax liability. Right? After we discuss, and then when we are discussing that investment income, we discuss that withholding tax and final withholding payment. Right? So then we have started the discussion, computation of business income. for income from business. So it doesn't say how to work out the business income. It says simply, so financial statement prepared as per the general acceptable accounting principle and practice. We are using as it is for tax purpose. Right? So it's simply said. We take the profit before tax. The financial statement. That is the basis for the computation of business income. From that, we are going to work out the assessable income from business. Normally, you know that in case of the business, we prepare financial statement. Right? It could be sole proprietorship, it could be partnership, it could be company, trust, or whatever thing. If somebody is doing business, we prepare financial statement. Right? So from that, we are going to work out the assessable income as to meet the requirement of tax law. Right? So then there may be adjustments. We do that adjustment. Right? So from that, we are taking the assessable income. That is the basis. Right? So when we work out the business profit, it says what are the things that need to be included here. Include here. So you know that say profit before tax or the loss before tax, whatever they. So in the profit or the loss, how it arrived in general term? Difference between income and expenses. Right. So excess, other things that need to be considered as part of income that need to be included. Right? These things need to be there. And there are things there. What type of expenses he can deduct? He can consider. And that we will discuss three areas, mainly three sections, three areas, three parts of the access, the translation, section 10 is it says general deduction. Says general deduction. Even though they are using the word deduction, it says that particular expenditure, anyhow, we cannot deduct. Right? We cannot deduct. No, not permitted to deduct. That is, even though section says it is general deduction. Under no circumstances, we can deduct expenses which is coming under section 10. Right? Remember, this is very important. When we work on business profit, definitely in the customs or whatever thing, this part will be there. Right? Thereafter, section 11. Section 11. That is called main deduction. It says main deduction. Right? Section 11 means about main deduction. It says what type of expenses we can deduct. Right? Says, it simply says any expenditure incurred during the year for during the year for generating profit, which is deducted. Remember, even if it is general term, if any expenses which is relevant to the generation of profit, which is coming in section 10, no deduction is permitted. So this section is not out. Right? So under no circumstances we cannot deduct. That is no chance we do. But section 11 says expenses to the extent that they incur during the year for the production of income, we can deduct. It's just like it gives some hints to some sort of expenditure that is also not allowed. Under section 11 as it says it's expenditure incurred during the year in the course of conducting the business to generate the income. So such expenses we can claim, we can deduct. So indirectly it says if any expenditure not relevant to that particular year, as well as not incurred to the generate of income, it is not allowed. Right? Doesn't say direct, says indirect. Right? So then section 11 also we have some sort of limitation of deducting expenditure. So section 11. So second thing is said, so subsection 2 says under no circumstances capital nature expenditure we cannot deduct. So even whatever expenditure which is incurred in the production of income, but it forms part of capital nature expenditure, so we are not allowed to deduct. So and also section 11 says what is meant by capital nature expenditure. Right? It says any expenditure which brings the revenue to the particular entity or the business over a period of more than 12 months is constitutes capital nature expenditure. Right? So not like other, so I mean very generally in the accounting terminology we learn that the capital nature expenditure. So but I say any expenditure which brings the benefit to the organization or the entity or the business over a period of more than 12 months, then it should be considered as capital nature expenditure. So then that is also not allowed. So here two parts. One thing says in the production of income, it definitely should be related to the generation of income. If it is not the case, it is disallowed. Second thing is capital nature expenditure. We cannot do. Right? So there are sections 12 to 19. That is extensive section of these things. It says any expenditure which is incurred in the production of income, and there are some specific treatment. It says some specific treatment. Right? Example, say interest expenditure. So it says okay, interest expenses. First thing, it should be qualified under section 11. That means it should be incurred in the production of income. Thereafter it says what sort of thing. And here also give some hints, some expenses we cannot do. Right? I think up to that point we have discussed in the last. Any question? No question? No question? All good? Right. So same thing. Right. Section 2 we discussed interpretation and then how the taxable income So person, definitions, zero punishment. So this is the part how to work out the taxable income, right? Then residency. Is that taxable income from business, right? So what does it mean by business? So important point is there is the intention is earning profit. We are not bothering about the fees. Right? Okay. So these things need to be included when we work out the business. Say service fee. Example is any business which is providing services. So then it should be debited there in the financial statement. If it is not there, we have to include. Consider fuel in respect of trading stock. That means realization of trading stock. So simply we can say CS. Gains from the realization of capital assets and liability of the business. Any capital asset used in the business, if it is realized for the sales or transfer, then we have to work out the gain from the realization of asset which is capital asset used in the business. Realization of depreciable asset of the business. So we recognize what is capital asset and the depreciable asset. So then if they are in realization, we have to work out. Consideration of accepting or restriction of business capacity. Right? So gift received in respect of business. Gift received. Amount derived that are effective contribute to the business. Other amount it can be. So as of not now, we don't have anything. So thereafter we discuss what is trade. The business interpretation. So important point here is motivation to make profit. Right? Motivation to make profit. Other thing is there is a repetitive nature. Recurrence chance to reoccur. Right? That is the main important point I could say when we recognize what is business. Main 2 points is so what's the intention of the transaction at the time of entering into transaction. Second thing is the recurrence. Right? That is actually so generally when we work out the assessable income, we use this type of format. There is no format in the environment. This is for easy use of our computation person. So then application of the usability of the how we can use the financial statement prepared as per the general. Yeah. Right. Next thing is so we stop there. Actually from today I want to start from here. So disallowable expense. So what things we cannot deny. Right? Disallowable expense. So general reduction under section 10, it says section 10A, section 10, subsection 1, it says no reduction shall be made in calculating the personal income from employees. So when we are work out the employment income, we cannot deduct any expenditure. Right? Even though that expenditure incurred for the generation of employment income from the employee side, we cannot deduct any expenditure. Example is so transport or traveling cost incurred by the respective employee. Right? That is not allowed. Right. Second thing is so section 10 subsection 1b says these things cannot be done. First one says domestic expenditure. Right? Domestic expenditure. There is a definition says what is domestic expenditure. Second thing says tax payable under the Inland Revenue Act. As per this act. So what is that? Income tax. That's why I referred that we are using profit before tax. Because that says we cannot deduct tax. So if we use the profit after tax, that means we have to disallow tax. Therefore, income tax under this act we cannot deduct. or other levies is determined by the Commissioner General. Rank, he can decide these things, these type of taxes not allowed. Then another part. Third one says interest, penalties, and fines payable for breach of any written law. Breach of any written law. That we cannot deduct. Expenditure or any other deduction incurred in derived exempt income or final withholding income. Any expenditure which is related to earn or the generated exempt income. Exempt income means exempted income under as per the tax law. Or any expenditure which is related to the earning final withholding. That is not allowed. Reason is that we are working out here assessable income from business. So assessable income. So why we are working on assessable income? We need to work out the taxable income. Right? Therefore, exempt income cannot be part of assessable income. Right? Cannot be part of assessable income. Right? Cannot be part of assessable income. We work out assessable income. Right? Therefore, here, this exempt amount and final withholding amount we are taking out. Therefore, any expenditure which is relevant to that exempt income or the final withholding amount, payment, receipt of final withholding amount, payment, that particular expenditure we cannot deduct when we work out assessable income. Right? Clear? Right. Second thing is, the next one is retirement contribution that is made by the employer or the person who is running business. If that benefit is taxing on the employee, right? Other side it should be part of income. Oh, that fund shall be approved by the Commissioner General. If it is the case, we can allow. Otherwise, it is not allowed. Dividend of the company, normally it's not coming under the comprehensive income statement, but if it is there, so we cannot allow. Outlay of expenses for entertainment. In entertainment nature expenditure, we cannot deduct. Reserve of provision for expenditure or loss not yet incurred but expected to be incurred in a future year of tax. Right? Just like provisioning. Right? Transfer to the reserve accounts or the provision. Any type of provision we cannot deduct. You know, in the financial statement we have so many provisions, right? Example, depreciation or bad debt provision. Whatever, provisions are not allowed because those not yet happened or expected from future. That is for the future losses. Therefore, that type of expenditure completely we have to disallow when we work out the link. Right? So next one is expenses incurred on lottery, betting or gambling other than the course of conducting of service. So any expenditure incurred in case of the lottery, betting or gambling. Right? Unless that particular person is doing as a business, then it is part of business expenditure. Otherwise, it's not part of business expenditure. Taxes of other ways, that is the previous one, is specified by the Commissioner General and any tax or levy which is not allowed to be deducted in calculating personal income in terms of any other written law. Right? So this is actually not new. This was there in the initial act also, but like some period it was not there. Now again it applicable. So where the person is allowed deduction for payment, from which the person is required to withhold tax under 11 Act. That means some payment. If they, some payments are subject to withholding tax. Withholding means when the payer makes the payment, he has to return the tax. If he is doing a business, he has to make so many payments, some payments. Example, salary, staff cost, or service fee, that he obtained from outside the supplier. So he has to make payments. So as the law says, tax law says, some payments are subject to withholding tax. That means when the payer makes the payment, he has to deduct tax. He has to withhold the tax. He has to hold the tax. Right? Right now, I can say there are three parts of this thing. First thing is employment benefit. Second thing is investment return. Third one is service. Right? So it says these types of things subject to withholding tax. Therefore, it is mandatory to pay to deduct withhold tax or the tax. Right? So if particular person, I mean to say, he is running a business, then he has to pay salaries to employees. That is as per the law it says, employment remuneration is subject to withholding tax. Right? If anybody is there in this classroom who is earning more than 100,000 per month as a under the employment contract, so then the company is deducting tax. You heard that? You may heard that. APIT, Advanced Personal Income Tax. Right? Then he is supposed to deduct tax. If he fails to deduct that tax, then particular expenditure shall be treated as disallowable expenditure. That is as per section 10, subsection 2. Right? So where a person is allowed a reduction, that means he is allowed to deduct that thing because it is incurred in the production of income, qualifying under section 11. So then he can deduct. But section 10 says, for payment for which the person is required to withhold tax. That means the payer is required to withhold tax. Under this thing, deduction shall not be allowed. Deduction cannot be claimed or the deduction cannot be made until the tax itself has been paid to the commissioner. It could be the two occasions. If he failed to deduct tax, that is also there. If he deduct but fail to remit to the tax authority or the commissioner account, commissioner general account, then he is not allowed to deduct that particular expense. Right? This is flexible area. My question paper it should be there. So this is very new. And I have uploaded this onto the LMS. Should be there. Section 10, subsection 2A. Different new thing. Last year of parameter 23, they have integrated this one. Right, say where a person pays to another person a sum of money amounting in aggregate of rupees 500,000 or more in a day, or in respect of single transaction or in respect of series of single transaction related to one event, otherwise than by way of an account payee check, account payee bankrupt, by use of credit card, debit card, or electronic payment system to a bank account. If somebody is making a payment more than 500,000 or more than any expenditure, if he did a transaction through this type of payment mode, then it is allowed. Otherwise, it is not allowed. It simply says any cash transaction, cash payment more than 500,000 or 500,000 or more than 500,000 in case of the single transaction or series of transactions for one event. Say if we purchase some item, I pay 500,000 each. Right? Series of transactions. One thing. So then it shall be part of this allowable. says any deduction shall not be allowed in respect of such payment. The amount paid cannot be considered as cost of finance. When I am paying employment remuneration, so for a particular person more than 500,000, I am making that payment in terms of cash. Then that particular expenditure shall not be considered as expenditure for actual. Right? I purchase an asset which is used in the business. I have paid and settled the total amount in the form of cash, say more than 500,000. So then that asset cannot be recognized as an asset for tax purposes. Say any deduction shall not be allowed in respect of such expense payment. The amount paid such shall not be considered as cost of finance. Okay. So this is not applicable for payment made by the government, bank or financial institution, class of person or payment made by maybe a specified means of that. So applicable for this government. If the government is making the payment, it's not applicable. Another thing is bank or financial institution is not applicable. So the definition for bank, account being an account maintained a bank or financial institution in Sri Lanka. Government institution means any department or undertaking of the government of Sri Lanka, any includes in public corporation, and single transaction means the purchase or procurement of any goods or services on a single invoice, receipts or statement. Right? So then domestic expenditure. What is it mean by domestic expenditure? So domestic expenditure to be disallowed. Where an individual incur expenditure for himself. Right? So normally you know that in case of the sole proprietorship, we consider this as not part of expenditure, right? So drawings. Where individual incurs expenditure for himself in maintaining, including providing shelter or as well as meals, refreshment, entertainment, or other leisure activities in the individual commuting from home, the transport cost, in acquiring clothing, including shoes for him, other than clothing that is not suitable for wearing outside of clothes, in educating him, other than education that is directly relevant to a business conducted by him and that does not lead to a degree or diploma, or in paying a personal debts, including credit card debt of the individual, in paying any interest incurred with respect to money borrowed by him and used for himself. It is considered as domestic expenditure. Basically, if any person who is running a business is doing this type of expenditure shall be part of domestic expenditure. So it says it maintains him. So that means person who is running business do some sort of expenditure to maintain other person, including providing shelter as well as meals. That means providing accommodation as well as meals. Right? It shall be part of domestic expenditure. As a section 10, it is disallowable expenditure. Second thing is refreshment, entertainment, other leisure activity. In the individual commuting from home, transport facility from home to business place. Right? In acquiring clothing includes shoes. In acquiring clothes, including shoes for him, other than clothing that is not suitable for wearing outside the work. That is exception. It says somebody is spending to purchase clothes of another person, it is treated as domestic expenditure. But that clothes that is not suitable for wearing outside of work, it is not part. Indirectly says it is allowed. What is that? Other than clothing that is not suitable for wearing outside of work. What sort of clothes? I am simply saying that, say, I am running a business. So on my side, I am an employer. I may have to execute some other, use some other, get some other services under the agreement of employment. So then I have to pay for it, right? So if I pay this type of thing, it is treated as domestic expenditure. If I am paying for him for the clothing, not allowed. It's domestic expenditure. But says that particular clothes or the shoes, other than clothing that is not suitable for wearing outside of work. That means that particular clothes that he cannot use outside. What type of thing? Example. What type of clothes here refer? So yeah, uniform. It is uniform. So we cannot use that uniform for private usage. You know that in case of the doctor, they are giving the government is providing some sort of uniform, which can be used inside the theater. He cannot wear that particular clothes and goes to public, right, function or whatever thing. So that type of clothes is not treated as providing clothes. Right. Here it's indirectly says uniform. So in educating him, any expenditure incurred by the person to educate another person, it is treated as domestic expenditure. Other than education, that is directly relevant to business. That is also exception. So this type of education expenditure is allowed again. Generally says education expenditure coming under domestic expenditure, but says other than education, that is directly relevant to a business conducted by him, and that does not lead to a degree or diploma. It cannot be a degree or diploma. Right? So, but if other than education, that is directly connected to the business. Say, you know that, say we recruit a new accountant, right? So there was a course which is going in, say, Sri Lanka, educating the recent development of the accounting standard. As a finance person who is a financial recording person who is engaged with the business under the capacity of financial accountant, he should know that, he should have that knowledge. The company can send him for that particular program and company can pay. Then it is directly under the business. Business need to prepare financial statement as per the country law. Right? So that particular expenditure shall not be part of domestic expenditure. But provided that it says again, if it is a degree or diploma, it is against what is domestic expenditure. Say the simple example, say, and each year we have the annual budget. Right? National budget coming in that in somewhere around November. So changes to tax structure and everything is discussed there. So finance person who is the reporting person related to the taxes and that thing he need to get that knowledge. Company can send that particular person for the budget discussion, budget seminar. So that is okay. So say company is spending on an employee who is following a degree. Example in this case, degree, applied accounting degree. Your company is making that pay. Then it is not allowed. It is again, even it is relevant to the business, even it is relevant to that particular business person's role, or the role in the company or the organization, that particular expenditure shall be treated as again domestic expenditure. Right? Right. So other things are I think clear in paying any personal debts, including credit cards or debit card, personal individual thing. In paying an interest in respect of money borrowed by a particular person, so shall be treated as domestic expenditure. Right? Any question? Domestic expenditure? No. So as per this section, don't you think whatever payment we have paid to the employee is not allowed? This is coming under the domestic expense. So we are paying salary for other person. Why? We are maintaining for him. We are providing say meals. Say in the factory they are providing meals. This is part of employment. Sorry, part of domestic expenditure. Say some companies providing the transport from home to office. Right? So most of this those expenditure, including salary, is just like domestic expense. That means can't be deduct that part. No, as per this section, other part it says these things are not part of domestic expenditure. Even it's a maintenance of another person, expenditure which is related to maintenance of other person, this type of expenditure shall not be part of domestic expenditure. And it says where another person incurs expenditure in making payments to providing any other benefits from an individual, the expenditure is domestic except to the extent that means these expenditure shall not be part of domestic expenditure. What is that? The payment of benefit is included in calculating the income of that person. Right? So from the employer side, we providing this type of thing. Employee side, it is part of, if it is part of his employment income, then it shall not be treated as domestic expenditure. Very, very simple theory in taxes. One person is making payment, then definitely it shall be part of income of the recipient. Right? Say company is making a payment in the form of salaries. In the form of salaries. So the payer side, it is an expenditure. Receiver side, if it's a resident person or the non-resident person, that's source in Sri Lanka, it shall be part of employment income. You may learn that employment income. If it is the case, it shall not be treated as domestic expenditure. Say companies providing meals to their staff. If we recognize the meal cost or the benefit to the employee side, then it shall not be part of domestic expenditure. Right? Second thing is provide consideration for equal market value for the payment of or benefit. If that particular recipient is provides consideration for the payback, so the pay it shall not be part of domestic expenditure. And also in the other side, there won't be such expenditure, right? It's just reimbursement. The company providing meals and company charging from him. There won't be any cost under the financial statement going under the staff cost, right? The amount of the expenditure is so small as to make it unreasonable or administratively impractical to account for it. If it is the case, then it is also not treated as domestic expenditure. Simple example, you know, in every company they are providing water. As to this section, it's part of maintaining first or tea, right? But it is very difficult to do administratively. The amount is very small to keep records, and it is unreasonable. Employers shall maintain good environment to workers to perform. So therefore, that should be there, right? So it is unreasonable or administratively impractical. We cannot work out what the particular person, how many tea he had, whether he had tea or the coffee or the plain tea or milk tea, whatever. So therefore, administratively it's not practicable. In such case, that particular expenditure shall not be treated as domestic expenditure. Right? Right. That is administrative. That is the administrator is practical to work out. Right. So these things shall not be treated as Domestic expenditure, even which is in definition part of domestic expenditure. So indirectly it says these type of expenditure we can deduct when we work out the assessable income from business. Right? Right. So what are the taxes that is disallowed? Right now we have anyway an income tax expenditure, including withholding tax, APID, and VAT on financial services, SSCL on financial services, profit insurance levy, subordinate tax, foreign trans levies, casino industry levy, these type of tax. If it is they are in the financial statement tax expenditure, we cannot. Right? That is actually disallowable expenditure. Right. Any question? So this will be main part of the business of profit computation. Right? Section level. Section 11, it says in calculating a person's income from a business or investment, says business or investment borrow. For a year, expenses to the extent that they are incurred during the year. It should be incurred during the year by the person and in the production of income. It shall be related to the generation of income, production of income. From the business or investment shall be deducted. This can be deducted. Incurred during the year by the person to in the production of income, generate income. Then it shall be treated as allowable expenditure. We can deduct. Expenses to extent they are incurred during the year in the production of income from the business is allowable to deduct when obtaining the income from business. So under subsection 2 says no deduction is allowed for an expenses of capital nature. We cannot deduct capital nature. So expenses of a capital nature includes an expenses that require benefit capable of lasting longer than 12 month period. That means the particular expenditure once incurred, the return of that expenditure is coming over more than period of 12 months. It shall be treated as a capital expenditure. So then capital expenditure we cannot deduct. Even that particular expenditure incurred during the year in the course of production of income. If it is that particular expenses bring that return, receive benefit more than 12 months period, then it shall be treated as capital expenditure. Example. Then make few examples. Capital expenditure. Right. Right. Appreciation. Sorry. Yeah. Acquisition of asset. So why? It's depend on the business, right? Say we do manufacturing. So when we are setting up a plant, then definitely capitalize expenditure by benefit on that expenditure coming more than 12 months. Set up a factory. It can be more than 15 years, or 50 years, or 60 years, 100 years, right? The acquisition of asset for the business. It's depending on the nature of the business. So, say we construct building to resell. Short period we construct and sell. So then it can't be coming under the capitalized expenditure. It's part of what is trading stock. In case of the real estate business and all those things. Right? So, another example. So, right now we do the expenditure. Income will generate over a period of time. Yeah, same part, right? That is also part of acquisition of assets. So, liability in the business. It shall be part of the property, plant and equipment. Okay. Other example? Sorry? Yeah, staff training. Good. So right now we do expenditure to train our staff. We don't know how long that benefit is coming to the entity. For example, yeah, staff training. Other? So training and development, right? Training and development. Other one?
Advertising expenses?
Sorry?
Advertisement expenses?
Good. Advertising and marketing expenditure. Right now we are incurring. We don't know how long we are getting that benefit, right? Good example. Yes.
Research and development.
Research and development. Good. Yes. Research and development. Right now we do the research or the development. So 2 points in the research and development, I could say. So we cannot relate how it's relevant to the generation of income. First one. Because as per this section it said, incurred in during the year in the production of income. So we do research right now, but there is no income generation. There could be more probably we cannot relate how research expenditure generate support to generate income. So therefore that's a special section. So how we can deduct the research and development. Another one, communication, other what it says, marketing and communication expenditure. Right, good. So this type of expenditure, as per the tax law, it's part of capital nature expenditure. Right, advertisement and make awareness of your business. Whatever expenditure we call that communication expenditure. Right, training and development, that type of thing. Right. Right. So there are things there. So then, so section 11 is a very critical section. So could be first thing is could be expenses should be incurred during the year. Second thing is it shall be incurred in the production of income. Right? Shall be incurred in the production of income. That means there should be a direct relationship earning income and that particular expenditure. Right? Example, staff cost, yes. Say transport, yes. Say telephone or the electricity, yes. We can say that other than if we don't have electricity, we have to generate. So therefore, we have to pay for that thing. So that should be required to earn the income. Right? Right. So then special deduction. So there is no called special deduction, right? But as per the tax law, it's a section 2. Certain expenses are specifically mentioned as allowable deduction. In such situation, the conditions specified such specific deduction provision shall be fulfilled, and thereby the general deduction rule under section 11 is not applied. The thing is, any expenditure we can deduct in the production of income. So this is the extension of the section 11. Let's say, in case of the interest expenses, section 10, section 12 says, interest expenses incurred by a person during a year of assessment under a debt obligation is deductible if money borrowed under such debt obligation was used during the year or was used to acquire an asset that is used during the year in the production of income. So in general terms, in the course of business, so we borrowed money and we are using for the either business. Borrowed money under the debt obligation was used during the year. But money should be used during the year or was used to acquire an asset. Purchase or the construction of an asset. That borrowed money should be used. And other condition for that asset related thing that is used during the year. Asset should be used during the year in the production of income. In the production of income. And in any other case, the debt obligation was incurred in the production of income. So basically, first class is related to long-term borrowing. So normally you know that. So borrowed money we are using to acquire or construct an asset. An asset is used in the business. You know that in other engaging, we use long-term borrowing to finance long-term capital assets for the fixed assets. So that is covered there. But condition here is that assets should be used during the year in the production of income. Otherwise, we cannot claim. So there is a restriction again. Say borrowed money has been used for an acquisition of assets. Assets should be used in the business, in the production of income. Otherwise, we cannot deduct that particular borrowing cost. Right? Example. We are paying interest on the loan what we have obtained, but to that loan has been utilized to acquire an asset, but asset has not used in the business. Example. What type of it? You know that in case of the building construction. So if it is take more than 12 months period, we obtain a loan, and until even though we have not completed the construction, we have to pay the interest. In some situation, not some situation, as per the accounting framework, we say that it can be capitalized. If it is capitalized, it cannot be part of the expenses which is in the comprehensive income statement. Then there we have no issue. But in any case, if we are charged to financial statement, that particular expenditure is not deductible. Right? Say we obtain a loan, import loan to import machinery. The machinery has not been fixed in the factory. So still that asset is not used in the business. Shall be used in the production of income. Right? So in all other cases, that obligation was incurred in the production of income. Generally, this is related to the working capital. We have working capital, we obtain facilities. That is allowed. Right. The money borrowed was utilized for the production of income or to acquire an asset for business, and the asset was used during the year in the business. That means asset should contribute to earn income. So this is applicable for any business, any firm. Next one is this is section 18. I talk about in one scenario. This is applicable to business or investment income and income other than a financial institution. Deductible amount of financial cost attributable to the financial instrument is to be limited to the formula. This is as per the form. Right? Before deductible amount of finance cost. Previous one is interest expense. Here it says finance cost. You need to think of that. Then, so this is the terminology what we are using is thin capitalization. It says, as per this one, say this is the maximum amount what we can deduct. It doesn't say disallow. It says this is the maximum amount what we can deduct. First, we have to decide whether it is a allowable expenditure. Right? Second thing is a maximum cap. This is the maximum amount what we can deduct for a year. Is a allowable finance cost or the attribute to the financial instrument is a total financial cost, that is allowable financial cost, divided by total cost of financial instrument. Right? Total cost of financial instrument means value of borrowers. Multiplied by total of the issued share capital and reserve into 4 times. That is the maximum what we can claim for a year. Right? So here resource exclude resource arising from the revaluation of any asset. Any residue of the financial cost that would not be deducted in a year can be carried over to 6 years applying same formula. Therefore, formula can be applied where share capital is exit only. Financial is defined in section 195 that says what is financial instrument. Finance costs also include loss with respect to financial instruments such as loss incurring the settlement of debt obligation. The formula we have discussed. In the case where there is no financial cost incurred during the year, in calculating the unused limitation for the above purpose, the limit shall be calculated by using the same formula. Right? Is there? Yes. First thing we have to recognize what is the amount that is allowable. Get to the financial cost. You know that in the comprehensive income statement, there could be interest cost. Right, it's not cost as well financial statement. Listen to me, please. Gentlemen. Excuse me. If you don't want, I can go. Oh, I forgot if you go. Interest cost as a financial statement. On that, first we have to decide what is the amount that should be allowed. Any disallowable amount. It says, so borrowing instrument that should be used to purchase and acquire an asset. Asset shall be used in the business, in the production of income. If it is the case, it is allowed. Otherwise, it is not allowed. Right? Another way, borrowed money used to acquire an asset, but asset not used in the business. Right? So it is not allowed. It is disallowed. Second thing is If the borrowed money not used in the business, that is also not allowed. So that is disallowed. Right? Unallowable. This is allowable interest cost. Right? From that it says there is a maximum limitation. The amount that can be deducted for a year. Right? This is the allowable financial cost. Allowable interest cost. Financial cost. In all cases, this is the total amount what we can allow. That is allowable. But on that we have to work out the what is that? Maximum limitation. It says maximum limitation is applicable person who is under that. Total of the issued share capital. Issued share capital. What type of entity has issued share capital? Public. Listed company. Not only listed company. Issued share capital. Any company, right? Even private limited, they have issued share capital. They are issuing share capital. So this is applicable only for company. Only companies having share capital. It could be public, it could be listed or private. Right? Any company who is having share capital, this limitation is applicable. Therefore, this limitation is applicable only for company. Partnership or the sole proprietorship, this limitation is not there. So once we work out the allowable cost, we get the sole proprietorship or the partnership that can be deductible when we work out the simple income. Thereafter, we have to again, in case of the company, we have to again see what is the maximum amount that can be deducted for a year. Right? As for this one, it says it should be equal to 4 times of the total issued share capital and reserve. 4 times. Right? In case of the company, maximum limit. It says this amount. That's the allowable amount. We have to deduct from the respective value of the borrowing. Financial instrument. This is allowable finance cost divided by respective borrowing value multiplied by times reserve. That is the maximum amount what we can deduct for a year. Right? If there is excess amount, that can be carried forward to next year. Likewise, it can be carried forward for a year up to the year 5. Right? So that doesn't say it is disallowed. That's the maximum amount what we can deduct for a year. Balancing, if any, that can be carried forward to the next year. Right? So remember, next year means we are carry forward amount. Right? Brought forward amount from the previous year. That is part of allowable financial cost. We need to worry about other things. Right? Always carry forward thing is happen from allowable financial cost. Okay? Is that clear? That is the amount what we can deduct for a year. This is applicable only for company. Why I am telling that? So issued share capital is there only in company. In the case of sole proprietorship or the partnership, we don't have issued share capital. Right? Sorry.
Sir,
Yes.
can we take a break?
And the most important question, right? Guys, we'll finish this week and then still on another 2 minutes. Right. So this is applicable only for company. Right. So anyway, that what is that? It is applicable only for company. Why? I am telling the share capital is there in only company. Right? The share capital is there only company.
Yes.
So when we work out this reserve, we have to ignore the revaluation reserve. We cannot use revaluation reserve. Right? Here, total issued share capital and reserve means the year-end balance. But reserve, we cannot. The revaluation reserve cannot be considered part of reserve. Cannot be part of reserve. So here, total finance cost means allowable finance cost, including interest. Second thing is also divided by total cost of financial instrument means which is relevant to the allowable financial cost. Borrowings which is relevant to the allowable finance cost. That is as per the borrowing value. Here, issued share capital and reserve, which is as at 31st March. But reserve doesn't consider the valuation reserve. That's the main point. Okay. Right. Then we go over back. From that, then it is allowable finance flow, they are being. Allowable means as per the law say, any finance flow which is going to borrowing that can be used for the activity asset or used for the activity which is not used for the. So that is we have to not really ROI. Say no, whatever finance flow first we have. Remove if that borrowing has not been used in the business. And if you remove or not done, as per the agreement. Then again, if that borrowing has been used versus an asset, acquire an asset, then that it has not been used in the production of industry. Yes, that is not allowed. So then this allowable first thing on the report is allowable. Right? Then we have kind of borrowing to set up a building, but the building has not construction has not been completed. Therefore, it has not been used in the business. So we have yeah. After the accounting data we can capitalize. So if it is capitalized, then there won't be finance cost in financial statement and there won't be the company income statement. So yeah, there is no the restriction to capitalize. So then it is allowed. Say another example. Say we borrowed money to purchase an asset to direct. So then asset is not used in the business. So then we are not using that. So then allowable finance. Right? So allowable finance. In case of the company, that maximum limit is for the team capitalization. Says this particular cost, financial cost. That's what. into 4 times.
So 3 times to 7.
No.
That's important.
Now it's 4 times. Yeah, now it's 2 right. So here we are taking only borrowed funds. 11 months. It's still not 11 months. Yeah. Okay. Yeah. It's financial. Living currently, bank can be, but finance cost. It is finance cost. The finance cost you are finance. Yeah. It is. Yeah, it says financial cost. Previous one says interest rate.
Mind only. Better family. Nine.
Right, we'll move to the next section. So that is for allowance for trading stock. Right? Allowance for trading stock, as per this section, section 13 says allowance for trading stock we can deduct. It says the deduction for the allowance for trading stock is allowed, and for determining allowance for trading stock, it needs to follow the general accepted accounting principle. A formula has been given in section 13. As per section 13, this is the way to work out allowance for trading stock. It says the opening value of trading stock of the business for the year, and expenses incurred during the year that are included in the cost of trading stock of the business, minus closing value of the trading stock of the business for the year. That is called allowance for trading stock. Right? Any concern? Any idea? This is the section 13 says how to work out the allowance for trading stock. Do you have any the understanding of this thing? Previous example or the experience? What does it mean really? So it says the opening value of trading stock of the business for the year, plus for that expenses incurred during the year that are included in the cost of the trading stock, less closing value of the trading stock of the business for the year. Any familiarity of this concept? Yeah, it's very similar to the closing stock. It's similar to the cost of sales. So it says opening value of the trading stock, then add to the during the addition to the closing stock, less closing value of the closing stock. So it says the opening value of the trading stock of the business for the year of annual shall be closing value of the trading stock of the business at the end of the previous year. Obviously, yes. Last year closing value balance. This year treated as opening value. So the closing value of the trading stock of the business for the year of annual shall be the lower row. Say shall be the lower row. The cost of the trading stock of the business at the end of the year, or the market value of the trading stock of the business at the end of the year. You know, in case of the trading stock, how we are valuing for accounting purpose. The accounting purpose, how we are valuing closing stock. Younger value. Accounting as per the standards. The value of stock inventories. It shall be cost of NRV, net realizable value. Right? Here it says cost of market value. What's the difference between NRV and the market value? So because initially that when we start the discussion, when we work out the business profit, we told that it is there in the act also. We are using the general acceptance accounting framework, principles. So it is in line with, right? So there is not much on the big difference in the market value and the NRV, right? NRV means that if we are selling inventory right now, what would be the realized amount? More or less equal to the market value. We deduct any cost to sell, completion to the sale, right? That can be done. So more or less is very equal to the cost of sale, right? So thereafter, this is the big area. So capital allowance and balancing allowance. In calculating a person's income from a business for a year of last month, remember it is for a business income. When we work out the business income, that means when we work out the assessable income from business, year of last month, the capital allowance shall be deducted. Capital allowance shall be deducted, and the balancing allowance shall be deducted. Says balancing allowance also deducted. So what does this mean? Capital allowance and balancing allowance, right? You know, as per the section 10, section 10 says reserve or provision for expenditures or loss not yet incurred but expected to be incurred in a future year of assessment, it is treated as not allowable expenditure. We cannot do that. Right? As example, we gave that what is that? Depreciation on assets. Right? On assets. Depreciation means assets which we are using in the business. Should be on, should be used. We do claim we do deduct depreciation, right? Work out depreciation. Right? Here it says depreciation we cannot deduct. That is as per the accounting treatment. Accounting depreciation is accounting treatment, right? So we cannot deduct. So here it says section 16 says we can deduct capital allowance. Right? It says capital allowances are granted in respect of depreciable assets. So remember, first thing we can claim capital allowances in calculating the business income. It means that we cannot claim capital allowances for other income sources. When we work out the business income, we can claim capital allowance. Remember, it says granting in respect of depreciable assets. It should be depreciable assets. Own and use. Similar to the depreciation treatment. It should be owned and used by a person at the end of the year of assessment in the production of income from a business and calculated in accordance with the cost schedule to that. The allowance granted with respect to particular year of assessment shall be taken in that year, shall not be deferred to a later year of assessment. Right? It means asset which shall be depreciable asset, which the ownership should be with us, with the business, as well as it shall be used in the business. If it is the case, we can claim, we can get capital allowance. We can deduct capital allowance. Right? Very similar to depreciation. But we are accounting. But as per section 10, depreciation we cannot deduct. We cannot deduct, but it's capital allowance. So hereafter, we are using the word capital allowance. Right? Capital allowance. It's very similar to the depreciation which we are work out for accounting purpose. Right? So it says depreciable assets. Of course, depreciation also work out on the depreciable assets. Right? Asset owned and used should be used, otherwise we are not working in the through the depreciation. Right? And it says In here it says own and use, but the important thing is in the production of it. It shall be remain in the year balance. Right? It shall be remain in the year balance. We have to work out as per the law. You know that so when we work out the depreciation, how it is there in the standard? What are the rates?
5 years. Lifetime is 5 years except for building.
What is?
Lifetime is 5 years except for building.
So depreciation, accounting depreciation?
No, for taxation.
You mean the capital also? That's the workout, how to work out capital also. Except for billion others.
It's 5 years.
Okay, that is for the capital also. No, I mean, so in case of the depreciation, what are the years? For each asset. You work out, I mean, you did financial accounting, right?
Based on the useful lifetime.
It's based on the useful lifetime. So there is no rate in the standard, right? Yeah, correct. So here also it says, but you remember in the for the purpose of accounting, depreciation is depend on the useful lifetime. How to determine the useful lifetime? Is based on the nature of business and the usage of it. Example, say in case of the information technology business, person who is in the information technology business, right? So computer may be for a very short period. With the change of the technology, is one factor determined when we are depreciating the assets, that the useful lifetime. So in case of another business, just like say person who is doing some sort of manufacturing or service sector, computer can be used 5 or 6 or sometimes 10 years or whatever. Depend on the usage and the nature of the business activity, how it's involved in the business, right? So therefore, so we in depreciation policy entirely based on the management discretion. Management can decide, and also they can revise. So this time, okay, we are depreciating our building over a period of 50 years. So thereafter they can say, okay, no, because of the impairment thing, we are depreciating over a period of 20 years. They can reverse that one. It's a matter of disclosing or they are making them adjustment of financial statement. They can continue that policy, right? Depreciation policy. But as per the law, tax law, it says the way of work out the capital allowances, right? We are using the word capital allowances. So how to work out depreciation basis of asset at the end of the year? That means asset should be there at the end of the year. Otherwise, we can work out the capital allowance. Right? And number of years. It says number of years. Depreciation basis of a depreciable assets means depreciation basis of the assets at the end of the previous year of assessment and amount added to the depreciation basis of the asset during the year. During the year of assessment. In respect of addition to the cost of assets. Right? So it doesn't say cost. It says depreciation base. Cost could be part of that one. As well as there may be addition to the depreciation base. Right? Right. So we are working out the capital allowances on its headline basis. We are not using the release and balance basis. Where a depreciable asset owned by a person is only partly used in the production of income from a business at the end of the year, but the cost of and consideration received for the asset shall be a portion according to the market value of that part of the asset that is used in the production of income from that business and that part of. Right? So that is how to get how to work out the capital allowance, which is partly used in the business, as well as how to work out the disposal impact for asset which is partly used in the business. Right, these are the rates. it says here, capital analysis and balancing class, it says computers and data handling equipment together with peripheral devices over a period of 5 years. Right? So any business, even IT sector or the manufacturing or whatever, computer and data handling equipment together with peripheral devices 5 years. So here 5 years, number of years 5 years, irrespective of the nature of the business. Right? And buses and minibuses, goods vehicle, construction and moving equipment. So basically, motor vehicles, heavy handle, purpose or special trucks, trailers and trailer mount containers, plant and machinery used in manufacturing. That's also fine. Then railroad cars, locomotives, that is also some sort of assets, equipment, vessels, trucks and similar water transportation equipment, just like you know that some boats, tugboats means boats which are used to take the ship to the deep water, deep sea. From the harbor, they have to take the ship. Harbor itself they can get the ship. So then they have to move that ship. So that's one also. Aircraft, systems, public utility plant, equipment and machinery, office furniture, fixtures and equipment and depreciable assets not including any other tasks. So that's also 5 years. Building instruction, similar work of permanent nature. That is over a period of 20. There are it says intangible assets excluding goodwill. Goodwill MA not qualified for capital allowance. The actual useful life of the intangible assets. The actual useful life is there. Or where the intangible assets has an indefinite useful life or a period of 20 years. So then, two things. Building structure and similar works of permanent nature that is 20 years. Intangible assets other than goodwill which has indefinite useful lifetime is 20 years. If that indefinite the useful lifetime is there or period of lifetime. So example for the intangible assets other than goodwill. Yeah, computer software. Computer software means it cannot be part of computer, right? Some software it shall be part of the computer, otherwise computer cannot be operated. I mean the example operating software is not it's part and parcel of the computer. Otherwise it's not defined as a computer. Right? So other than that, say example ERP or the what is virus card, like the accounting package, that type of software, right? So if there is a useful lifetime or period of useful lifetime, otherwise 20 years. Then making which latest technology used in manufacturing local liquid milk. Right? That is only that particular industry that is included. So basically, other than building intangible assets, this specific business industry, meeting industry, other than other assets over a period of 5 years. Right? Condition is we have the ownership. It should be using the production of income as it should be there in the year and balance. The case we can work out that we can claim the capital allowance. Name is capital allowance. Right? Allowance to capital. Right. So here it says motor vehicle. So road vehicle. The good vehicle. What is good vehicle? Goods vehicle. Right? The good vehicle, goods vehicle. No capital allowance shall be granted to a person in respect of road vehicle. We cannot claim capital allowance for road vehicle. Other than, but these vehicles are again qualified for capital allowance. Other than a commercial vehicle, a bus or minibus, a goods vehicle, a heavy general purpose or specialized truck or trailer, or motorcycle. That is, we can claim capital allowance for these assets, even motor vehicle, right? So commercial vehicle means a road vehicle designed to carry loads of more than half a ton or more than 13%. That is treated as commercial vehicle. So commercial vehicle entitled for capital allowance. What is commercial vehicle? Road vehicle. So all are road vehicle. Road vehicle designed to carry loads of more than half a ton or more than 13 passengers, or a vehicle used in a transportation of vehicle or vehicle rental business. So then capital assets is entered. So indirectly it says vehicle which is used for traveling purposes. Traveling purposes, we cannot claim capital assets. Right? So especially they are addressing the vehicles. Vehicle which used for traveling purposes, we cannot claim capital assets. Right? Example, what is the difference between traveling and transport? It doesn't say transport, right? Here, vehicle used in the transportation or vehicle rental. So it says for goods vehicle and transport, capital loss. Thereafter it says no capital loss shall be granted to person in respect of road vehicles. Other than these vehicles, no capital loss is entered. Commercial vehicle. So thereafter it says commercial vehicle means vehicle used, which is used to carry more than half a ton, so 13 passengers. Right? Thereafter it says vehicle used in the transportation of vehicle rental business. That is entered for capital loss. Other than these things, any other vehicle we cannot claim capital loss. Right? So indirectly it says vehicle used for the traveling purpose, we cannot claim capital loss. Right? So what is the difference between traveling and transport? Transportation. So when the public transport. Is it the case always?
Or like transporting goods.
Yeah, transport of goods and there. Vehicle is for the transport. Right? Search and give the answer next time. Okay, what is the difference in traveling and transport? Right, okay. So after this one, transportation is fine. That vehicle used for the transportation, that we can claim capital loss. Right? Right. I'm asking that question in the next class, right? Okay. So now this says how to work out the capital losses. Remember, this is the formula we have to use. Depreciation base, remember, depreciation base of that is at the end of the year of assessment. That means the year of assessment is what we are considering, divided by the number of years. Right? Doesn't say useful lifetime, number of years. Number of years says in this particular table, you have to remember 5 years for all other assets other than building, excluding, building, structure and similar works. Structures mean, okay, answer to this question. But what do you mean by building? Building. What do you mean by building? Building, of course, there is a definition act of itself. So general understanding building is what is constructed using metal, cements and everything, that type of thing. So then you know that now in Sri Lanka we have building which is constructed using metal. As per the general definition, it is not part of building. Right? Here it doesn't say what is building, but there is a definition that. So you know that in case of the vehicle service station, police station, is it part of a building? Right? You know that in some what is that vehicle repairs, what the person who's doing vehicle repairs, they have some sort of what the structure where you can they can take the vehicles up and turn whatever. Right? Does it constitute part of building or is it a building? So that's what is there because that debate was there. Structure and similar. It is not complete building, it's a structure. Even that's also accounted for capital loss. Otherwise, it's a building that is out of the definition. Therefore, that type of business, say, you know that in fuel station, they have the roof and the only that, but the pillars, right? Only that. So, but as per this, what the schedule, that structure also accounted for capital loss. So then, balancing losses are made in respect of depreciable assets realized during a year of assets. That's the realization of assets. As a realization, we have to work out the balancing allowance, which capital losses have been granted in that year or an early year. So it could be earlier or this year, right? Computation of balancing loss, how to work out, written down value of the asset at the time of realization of the asset. We have to get the written down value, less consideration received by the person during the year of action for the asset. Then remaining thing we call balancing allowance. Written down value of the assets at the time of realization of the asset means the expenses incurred by a person in acquiring the assets reduced by all capital losses granted to the person. You know that in the accounting terminology also, we are working out the written down value. How? Cost minus accumulated depreciation. Likewise, here says depreciation base minus capital loss up to now, we can deduct. Remaining part we call written down value. Right? Same thing. So, if the written down value is in excess of consideration received, that means sales proceed, the answer we call balancing allowance. Right? It indirectly says is there any loss of disposal of assets. Right? That should be treated as balancing allowance. Balancing allowance we can deduct. That means any asset which qualify for capital allowances at the time of the realization or the disposal. If there is a loss, that is allowed for tax work. But the term that we have used for the loss, it is mean balancing allowance. We are giving another allowance to balance that tax. So therefore it's called balancing allowance. Right? Right. Next one is accessible charges are recognized in respect of depreciable assets realized during the year of assessment, which capital losses have been granted in that year of assessment or an earlier. Consideration received by the person during the year of the assets, that is disposal proceeds minus written down value. If the sales proceed is higher than the written down value, then there will be a profit. Right? So profit we call accessible charge. It is part of accessible income. Right. Wherever depreciable assets goes central for enhanced capital losses is realized and accessible charges included in calculating the person's income for the year shall be equal to the consideration received for the assets. No balancing allowance shall be granted for such assets. That is additional thing, right? So by going with the Yeah, how it goes? So balancing allowance. This is called balancing allowance. Written down value is higher than the sales proceed. It is balancing allowance. It is allowed. Right? So how to work out the written down value? Minus capital allowance. This year or earlier. Right? So then accessible charges. Accessible charges. Right? Here disposal proceeds is higher than the written down value. Here then it says that we are profit. Can be add to the profit. Right? So here this deductible. So therefore, when we work out the business profit, if there are any accounting adjustment on the disposal of assets, we ignore. It's not considered as part of business income. So we have to ignore that one and we have to redo the tax adjustment and accordingly we have to adjust the clear? taxable charge. So there are these talk about the enhanced capital loss. What is enhanced capital loss? Person who invests in Sri Lanka, this is actually investment incentive. Other than the expansion of existing business, so expansion of existing business. During the year of enhanced capital loss shall be charged. This is an investment incentive, and such allowance is charged in addition to the capital allowance. Granted for depreciable assets. Investment shall be made on depreciable assets other than intangible assets. Right? It says apart from the capital allowances, if someone is any person who invests in Sri Lanka, as per this section, is entitled to claim enhanced capital allowance. That is additional capital allowance. Right? Further capital allowance. Further allowance. It's called enhanced capital allowance. During the year, shall be under. This is an investment incentive, and such allowance is granted in addition to the capital allowance. That means he can claim the capital allowance as right. Depreciation, but that investment shall be made on depreciable assets other than intangible assets. So not allowed to that enhanced capital allowance is not given for intangible assets. So it goes as this investment exceed USD 3 million, but does not exceed USD 100 million. Asset used in a part of Sri Lanka other than other projects. So 100% allowance is entire. Say we are going to start a new business, right? The total project cost is more than 3 million USD, and we do the investment in say Colombo district. So then we can pay 100% as enhanced allowance, enhanced capital allowance on the depreciable assets what we have invested. Investment shall be exceed on USD 3 million, right? Up to USD 100 million. Apart from the capital allowances, they are entitled for enhanced allowance. That is double deduction, right? So I mean we can claim the normal capital allowances as per section 16, as well as we can get the enhanced capital allowance to encourage investment. That's why it's called investment incentive, right? So other than expansion of an existing business, so entirely should be new. Exceed, if it is exceed 100 million USD used in part of Sri Lanka, it should be in other points, not other than. It should be in other points. I will do that. 100% of the expenses incurred by a person on depreciable asset. So he is entitled for 150%. If somebody is doing that investment in other points, he is entitled for a enhanced capital allowance equal to 150%, 1.5 times. That is enhanced capital allowance, right? Exceed USD 3 million used in another project. Sorry, this is the used in another project. 200% of the expenses incurred by a person on depreciable asset. So two things I will explain. So it says investment incentive. that person invest more than $23 more than investment. Other than right? He is entitled to 100% enhanced capital loss. The same we have invested $3 million USD in new project on depreciable asset. Depreciable assets, right? Same we have set up a factory, so then building, right? Building plus the equipment everything. So normal we can claim capital allowance. Divided by 5. That is capital allowance. Apart from that, you can deduct entire 900,000, 900 million as enhanced capital allowance. Entire thing you can claim the first year. Right? So apart from that, and only you can claim capital allowance. Right? In addition to that, once he complete the investment, he can get the total amount as a deduction. We call it a enhanced capital allowance other than other employees. Clear? That's clear? If it is more than 100 million investment, this is up to 100 million, more than 100 million. Other than investment is made other than other employees, he can entitle that is the 3 equivalent, right? Enhanced capital losses equal to 1.59. That is enhanced capital loss. Apart from that, he can claim capital losses as well. Right? Basically, if somebody is starting new business in the very first year, there won't be any taxable income if he is entitled for enhanced capital loss. Why? He can claim entire investment as a deduction apart from the capital loss. Right? Right. If it is in the another employee, it is 200%. If it is in another point, it is 200%. This is correct. Another point, it is 200%. The reason is, after 2009, that government has to invest in develop the area where that but the conflict is there. Other projects. Therefore, as per the tax law is encourage the investment to move to other projects. They welcome the investment in area and other projects. That's why it says 200% enhanced capital loss. It's 3 times deduction. So you can claim capital losses as normal. The normal is under section 16. In addition to that, we can claim 200% of the investment as in our capital loss. Right? Is that clear? Right. So if you work out this, what is this? Taxing. So we are taking a profit before tax. So then any depreciation and accounting depreciation we have to add because it is not allowed. Then we can deduct capital allowances. Right, as per your 20 years based on that. And also we can claim enhanced capital allowance. Right? This is additional deduction. This is based on investment. The area they do business, it shall not be existing. New business. New investment. Other than expansion, just other than expansion. Now, capital allowance we can get. Addition. Remember, it is not there in our income statement. In addition to that, some items tax law says you can deduct. There is no real expenditure which has been considered when we work out the profit before tax. Right? You know that accounting depreciation, yeah, we have already considered. So it is not allowed because it as per the law it says it is provision, it is not allowed. But they are giving capital allowance. So we can deduct. Apart from that, total cost of the project or the investments, we can deduct as enhanced capital allowance. If these criteria are satisfied. So basically in the first 2-3 years, there won't be any profit to tax because of the enhanced capital allowance. Right? So qualifying conditions are investment shall be made on depreciable assets. It should be exceed $3 billion USD, United States dollars, and investment could be in Sri Lanka other than another person or another person. If it is another person, 200%, other than another person, 100% or 150 based on the value of investment. Right? Entirely we can do that. Clear? Right. So thereafter, so Tax authority has given, the tax law has given 3 years to complete that project because previously it was not there. Just like the entire investment you have to make within a period in the year. But there it says commencing from the first day of the investment on depreciable asset, 3 years of project implementation period shall be provided to a person who has not made his intended total investment. Right? They are considering 3 years. In-house capital loss shall be deducted in the year of investment which he has completed the total intended investment, but before the expiration of project implementation period. So thereafter it says, for the BOI approved company, this is special thing. A person who has entered into an agreement with the Board of Investment of Sri Lanka, established under BOI law, and investing Sri Lanka in the expansion of his existing undertaking. So for the BOI undertaking, existing enterprise also entitled to capital capital loss. There's expansion. Existing undertaking during a year of investment. In addition to the capital losses, enhanced capital losses shall be granted. So other than BOI enterprises, other person, enhanced capital losses as we discussed earlier. It shall be new undertaking. Investment criteria shall be more than 3 billion USD based on the area. They are entitled to enhanced capital losses provided that investment shall be made in depreciable assets. Right? Other than intangible assets. For the BOI enterprise, even existing business also entitled for enhanced capital loss. If they are doing expansion, they are entitled for enhanced capital loss. Right? What is the existing undertaking? Means any undertaking conducted by a person prior to the first day of the investment of the depreciable asset. That means, so when before they invest in the asset, they are in the business. That is treated as existing undertaking. Expansion does not include the transfer, purchase, or exchange of depreciable assets of an existing business. The purchase of a depreciable asset to replace an existing depreciable assets of an undertaking of a person. The expansion means there shall be a increase of the business, growth of the business. Right? Replacement of asset doesn't count under the expansion, as well as purchase or exchange of depreciable asset of an existing asset or from associated entities does not count as an expansion. Right? Clear? So it shall be, there shall be capacity increase. Since it says capacity shall be increased, that is called expansion. Or they can go for move on another area of the same, say backward integrated or forward integration, likewise. Right? So it's not necessarily a new one. So new undertaking means it shall not be a new entity. Right? Existing entity can be undertaken another project. Say we do manufacturing, thereafter they are going for a hotel business. That is also undertaking. It's a new undertaking. Right? Right. New undertaking does not include the existing undertaking or undertaking form a splitting up or reconstruction of existing business undertaking. Right? Another area, improvement on leasehold land. In any building, structure or similar work of a permanent nature constructed or made in a leasehold land by the person who made the investment shall not be deemed as an intangible asset, but deemed as an depreciable asset. Thing is that you know that especially in some cases, the land belongs to government. So project is going as an in the leasehold asset. Say UI or special development project. Therefore, whether they are entitled for the depreciation of the building. But for the accounting term here, he can claim. But as for the tax law also, because tax law once time it says that ownership shall be there. But even the building structure, something is doing on a leasehold asset, they can claim that deduction. This shall not be treated as intangible assets. Tangible assets, you can claim allowance. A person who has entered into an agreement with the Board of Indian of Sri Lanka, established under the BRLO, and invest in Sri Lanka in the expansion of its existing undertaking during the year, shall be granted enhanced capital allowances in addition to the capital allowance. Right? So we covered that. Now remember, for the computation side, depreciation as per financial statement or accounting depreciation, it's not allowed for the reduction. In lieu of that accounting depreciation, we are giving capital allowances. So we can claim capital allowance on depreciable assets, own and use. Remember, own and use means even asset which is under the financial lease also treated as own and use, own asset for this tax law purpose, right? So you know that it is in the financial statement also in the even asset which is under the financial lease we are disclosing as our assets, right? Substance or more. So here also we are entitled to capital allowances, right? So base capital allowance shall be granted on the depreciation basis and as per the number of years specified in the act. Right? Other than building intangible assets and assets used in the making industry, all the other assets is 5 years. Building structure and the intangible assets which has indefinite useful life is 2 years. Machinery used in the milking industry, local industry, 2 years. So intangible asset which has useful lifetime or the useful lifetime. Okay, we can claim capital allowances. Enhanced capital allowances is entitled for new undertaking or existing BOI undertaking. Right? So investment minimum criteria on the depreciable assets other than intangible assets shall be exceed USD 3 million. Right? If it is above USD 3 billion and below 100 million, and investment made in other than any area other than other coins, he is entitled to 100% enhanced capital allowances. If it is another area, 150%. Sorry, 200%. If the investment is more than 100 million, investment made in any area other than other coins, 150% enhanced capital allowances equal to that amount can claim. If it is other area, again 200%. Right? Enhanced capital allowance. Any asset which is qualified for enhanced capital allowances and subsequent disposal, total sales proceeds shall be treated as business profit. Okay? No balancing account for assets which qualify for enhanced allowance. Right? It's that. So where are depreciable assets was entitled for enhanced capital allowances is realized and acceptable charges including the calculating the business the person's income for the year shall be equal to the consideration received. Total sales proceeds we have considered as acceptable charge. For asset, no balancing allowance shall be granted for such. Is that clear? Any question? Any question? No question. Okay. Can I ask question? If you don't have a question, I can ask question. Another question from my side. From the enhanced capital allowances is very clear, right? It's depend on the investment, and it shall be made on depreciable assets other than intangible assets, right? So if it is the case, we can claim the enhanced capital allowance and but the capital allowances. Any question? No. Understand? So we are good to go. Next we have a good question, right? So why I discussed that capital losses, that we have in section 16. Before that we discussed section 11, 12, 18 and 16. Section 13 also we covered. Right? So 14, 15 we didn't discuss. Right? So we'll move to the section 14. It says repair, maintenance and improvement expenses. Actually repair and improvement expenses. Expenses for the repair, the maintenance or improvement of depreciable assets incurred during the year for the production of income of a person shall be deducted irrespective of whether they are of a capital nature or not. So this section says even though capital nature expenditure we can deduct. Under section 11, capital nature expenditures we cannot claim. But this section says in case of the repair and improvement, right? Irrespective whether they are capital or not, we can deduct. So this section allows us to claim capital expenditure, capital nature expenditure. This is one section we are meeting. We can claim capital nature expenditure. Right? However, improvement expenses for any year of expense which respect to an depreciable asset of a person shall not exceed. So then there's a maximum cap for improvement. It says repair, maintenance, improvement. It says improvement, there is a maximum limitation for a year. It means repair and maintenance, irrespective of whether they are capital or revenue, we can deduct. Right? So remember, more or less, the repair and maintenance expenditure doesn't count capital nature expenditure. What is the difference between repair, maintenance and improvement?
Improvement is something that enhance the lifetime of the asset.
Repair doesn't.
We can link the
Yeah, when something is broken, you repair it. Maintaining it before something is getting broken, you like maintain properly to avoid like breakdown or something. So
An unplanned breakdown.
Yeah. So improvement is taking that thing into another level.
Okay. So if I put it in that way, that interpretation is almost there. So of course the value of the asset is going up because of the improvement. But maintenance and repair doesn't improve the first the value of the useful lifetime of the asset. I mean the value is going up means definitely the useful lifetime also going up. Right? So it's about the capacity. Capacity. You know that when the usage of the asset, the capacity going down at an expected level. So that once you purchase a computer, after some time that the processing speed and everything is going down, right? So then the capacity going down with the technological development also going down, right? Some for the some software is not supported. Therefore, that he cannot use that particular asset. So keep the asset at the expected condition, or get the expected capacity of it. So we do repair and maintenance. Right? So improvement, of course, related to the enhance the useful lifetime or value or the capacity. That is called improvement. Basically. Therefore, most of the case improvements count for capital nature expenditure. Even for tax purpose, even if it's a capital nature expenditure, we can deduct. But there is a maximum limitation. Right? It says, however, improvement expenses for any year of assessment with respect to a depreciable asset of a person shall not exceed, is the maximum amount. Building structure and similar work of a permanent nature, 5% of the written down value of the asset at the end of the previous year. That's the maximum improvement cost what we can take. In case of the building structure and similar work, so what we can claim as improvement cost, 5% of the written down value of the previous year. That's the maximum amount what we can claim. Right? All other class of assets, 20% of the written down value of the asset at the end of the previous year. Other assets, maximum amount what we can claim is limited to 20% of the written down value of the asset at the previous year. That is for the improvement. Repair and maintenance, we can do that. There is no limitation. Excess amount incurred over the maximum allowable amount shall be added to the depreciation basis. If there is excess amount, that shall be added to the depreciation basis of the asset at the end of the year. Right? At the end of the year. So that's why when we discuss the capital losses, we work out the capital losses on what is not the cost. It says depreciation basis. Depreciation basis means asset at the end of the previous year of the asset and amount added to the depreciation basis of the asset during the year. So therefore, there is a chance where part of improvement cost added to the depreciation basis. Right? Clear? So excess amount incurred over the maximum allowable amounts shall be added to the depreciation basis of the asset at the end of the year. Depreciation basis at the end of the year. After claiming this year capital losses, that is the amount remain as depreciation basis. For that amount, we can add improvement cost. Okay. Excess of the risk. Right? Okay, clear? So, in the event we are written down value of the depreciation asset is 0, so we don't have depreciation basis in the last year, end of the last year. The reduction for improvement expenses shall be equal amount apportion. Oh, that means equally we can apportion over the other 12 years in case of the building structure and in case of the other assets for we drop 3 years. Right? Commencing from the year of assessment if the expenditure was incurred. Improvement means, definition is that improvement means the expenditure incurred by a person to make addition or alteration to the depreciable asset which enhance the value of such asset but exclude the expenditure incurred to maintain or repair a depreciable asset which temporarily enhance the value of such asset. And it doesn't count as improvement. Improvement says addition or alteration to the depreciable asset which enhance the value of such asset. If the value of such asset is going up, then it shall be treated as improvement. Is that clear? Yes. The improvement. So basically, there is no repair. Repair cost entirely we can claim. And maintenance, that is also we can claim improvement. Basically, these are capital nature. Right? Depending on the class of asset. Class of asset means as per the capital asset table. It says building structure. Previous year. That's the maximum what we can claim without this thing. Other class of asset. That is the maximum what we can deduct this particular year. If there any excess amount, that's the maximum amount, right? If there any excess amount, that can be added to the written down number at the end of the year. End of the year. Right? That means after claiming capital loss. It's not only at the end of the year means after claiming capital loss. That amount we can add. Right? If there is no written down earlier, previous year, then four period earlier equal basis, other than 4 period of 3 years. We can deduct. That is the maximum inflation. Right? Okay. Any question? Right? So now you know that if there any excess amount or the on the maximum cap is this, then excess amount we have added to the depreciation basis at the end of the year. Can we claim capital loss on that? Can we claim capital loss next year? For this year? We add into the depreciation basis excess amount. Can we claim capital loss? Okay. Question is whether that particular amount once we are added here, on that can we claim capital allowance? Huh? Can you claim? I mean to say improvement cost. There is a maximum limitation what we claim can deduct for a year, no? Right? So on that, whether we can claim capital allowances. So in simply in the financial statement, then there won't be that improvement cost won't be there in the financial statement on the comprehensive income statement. No?
Yes.
It shall be either part of asset or somewhere under the what is that WIP or whatever thing. Right? So, but as for tax law it says improvement cost you can claim even improvement cost you can deduct subject to the maximum limitation. But the limitation based on the class of asset previous year written down earlier, on that we can claim some amount. Right? If there any excess amount, it says you have added to the depreciation basis at the end of this year. So can we claim capital loss?
Yes.
Yeah, we can claim. Which year? Yeah, next year onwards we can claim. This year we cannot claim. It says written down earlier at the end of this year. That means after we claiming capital allowance, if there is remaining written down earlier, that we can add. Clear? If we don't have written down earlier, then it's straight line basis based on the asset for a period of time, 12 or 3 years. Clear? Clear? It seems not clear. Right, we'll see. Because remember, when we work out the depreciation of the capital asset, it says depreciation basis. The depreciation basis means amount added to the depreciation basis of the asset during the year. Right? Depreciation basis means anything added to that asset. So that is they are referring that improvement cost. Right? Referring to improvement cost. Another question. Company which is doing this type of business. Say you know that kangaroo cap or the pygmy, not pygmy, kangaroo cap. They do they use motor car and on that they are getting service income. Are they entitled to claim capital loss on vehicle?
Yes.
And what category?
Due to the production, they are supporting the production of income.
Yeah, I mean, let's say vehicle, whatever we are using in the business, we can say that it's to what we are using for the production of income. Because it says what the commercial vehicles and the road vehicles. Road vehicles are not entitled to capital losses. Only goods vehicle. In which category we can claim capital loss? That is the difference between traveling and transport, right? Yeah, it says commercial vehicles. Commercial vehicles are entitled for capital losses. Definition for the commercial vehicles is a road vehicle designed to carry loads more than half a ton or more than 13 passengers. So that is a commercial vehicle. Even a road vehicle. A vehicle used in a transportation or vehicle rental business. That is business they are doing. What if they do? Transport. Transport of passengers. So they are entitled to capital loss. Vehicle rental business, it's like Maliki rent car. Right? They are renting or the hiring business. So they are also entitled to capital loss. Right? Yeah. Yeah, next section is section 15 and section 15A. We'll discuss next day. Right? Next day I am giving a question. You have to answer that one. Right? So whatever discussed up to now, I am giving question. The short question. You have to answer. Right? I will put it to the LMS. I think you can access to the LMS. I mean my presentation is there. Right?